Lon Welsh, welcome to the show. How you doing, my friend?
I'm fantastic. Thank you for having me.
Absolutely. So we talk a lot over tacos. We haven't talked much on computer screens, but for those in my audience that don't know you, which probably most of them do, you're the founder of Your Castle Real Estate, a brokerage that was focused on investment properties. You're the founder of Ironton Capital, a microcap private equity fund focused on real estate and debt deals, right?
hmm
And you're just a really smart man who's been of great service to the real estate community here in Colorado and actually outside of Colorado. You've taught at NYU. You're kind of the man, and it's a privilege to have you on here. It's an honor to call you my friend. Welcome.
Thank you for having me. I'm really grateful to be here.
So, just to get the disclosures out of the way, I mean, we're going to be talking a lot about the stuff we always talk about, right? Making money and investing. But this is by no means investment advice. We're not
No.
calling for, investments right now. Nothing like that. You've always got to talk to your professionals, your CPAs, your attorneys. Investing is risky. And now that that's out of the way, let's talk about some investing. So,
Love it.
a little more disclosure. I've worked for you. I have some money invested in one of your funds. You've launched multiple funds. What's really admirable and cool about how you launched your private equity fund, in my humble opinion, is you did it all with your own money at first. And I think you launched fund one,
Four.
two, three, and
And four.
four
Yep.
completely with your money, made sure you're good at it. Of course, you're going to be good at it, but you made sure. And then you started investing other people's capital. Give me the short journey from 1 to 4 and then 4 to 10.
Sure. So I've been an active real estate investor in Colorado for a couple decades. First doing fix and flips, then as a landlord, and then doing development, and then turnarounds on office buildings and apartment buildings. And starting 6 or 7 years ago, prices in Denver had gone up so much, it was difficult to find the projects that had the kind of returns that I was used to. So even though we had really strong rent growth, the appreciation was even faster, and the net, it just didn't make sense. And I've been doing this long enough. I don't probably have to prove I can slay any more dragons. I'd like to maybe work a little less. So I started looking at investing passively, and I really investigated that for about 18 months, and I thought I knew enough. And then the first four funds were just my family's money to make sure that we kind of had it really dialed in. And by 2022, it was pretty clear that, wow, the strategy that we've put together here is really going to diversify risk even better than I thought. And interestingly enough, my wife's a physician, and she's got a friend who's an anesthesiologist who runs a women's investors group. And she was
Okay.
telling me how frustrated she was that they couldn't find anything that cash flowed anymore. And I said, well, here's what I'm doing. And she said, wow, would you do a presentation for my group? And she gets 53 of these women physicians on a Zoom call. And I explain it, say, look, if we all collaborate, I could write checks for $500,000 or $1 million at a shot instead of 50 grand. I could negotiate much better terms. I'll see lots of deals I can't see now. I can start getting access to institutional deals that small investors don't get access to. Here's how it would work if it's profitable. I only get paid if it works. Do you want to do it? And almost everybody said yes. We raised several $1,000,000 on that call. I said, this is what I'm doing next.
That's great. And you've done well with it. And that's a big thing that I've seen, at least myself and my crew of friends, many of them, that we wanted exposure to these, dare I say, institutional grade investments, or at least investments that, was traditionally reserved for people who could write big checks, family offices, folks that simply wouldn't take a $50,000, $100,000 check. You need to write a 7-figure check.
Yep.
So when you pool that money, now you have exposure to where the bigger boys and girls play, and
Yep.
and dare I say, maybe some more sophisticated operators. Not maybe, we know they're more sophisticated, more
Absolutely.
successful. So that's what you've done. Now you've done that with multifamily real estate, and you've developed these funds that risk diversified because you're talking about a whole bunch of doors as opposed to one door, right?
Right.
How you also launched some debt funds, right?
hmm
Let's talk. You've got a short term and a midterm.
hmm
How do those accessorize, or how do those complement the equity positions?
Yeah, so we've got a short-term income fund, and our sponsor partner on that is making hard money loans. It's a portfolio of about 300 loans, usually at any moment in time, and that pays around 8%. And then it does have a tax advantage, and that it's taxed as a REIT, a real estate investment trust. So if you're in a high marginal tax bracket, you'll probably find when you talk to your CPA, a REIT will be taxed at closer to 20, even if you're like in a marginal of 35. So it can really be a nice financial gain for that, and it's highly liquid. And then the one that we're much more active in raising money for is called our medium term income. And that's medical receivables. So if you have two people get into a car accident, maybe you're driving with State Farm and I've got Geico, it's not clear who's at fault, and the attorneys are going to take 18 months to resolve it. The physicians and the clinics, they've got a lot of things they've got to pay for within 30 to 60 days. They can't wait 18 months to get the cash in the door. So what our sponsor does really that's beneficial is they take over the paperwork process for the administration of the insurance claim, because the doctors, they want to focus on treating patients. They don't want to focus on chasing down documents. That's really what the client is buying from us. And then the fact that we're advancing money against the receivables, called factoring, that's really sort of just the icing on the cake. So our preferred would be to have a claim somewhere around 30,000 bucks. We advance about 10,000. So there's a lot of security in the claim. And we want to work with a high volume provider that maybe we could do like a basket of about 100 of these claims. We might advance on 90 of them, but they're all cross collateralized. So for the people in your audience who are more real estate focused, the analogy would be if you had 100 rental properties that were paid off and you came to me as a bank to get the same terms, I'd give you a 35% loan to value on 90 of your properties, but they would all be cross collateralized by this one master loan. And if you defaulted on any one of your 90, I could go after any of the other 99 to get paid. So nothing is ever foolproof, but this is pretty good.
Yeah, that is strong. I like cross collateralization. Obviously, not only me, everybody likes that.
Everybody does.
Yeah, and so you're diversifying the risk amongst these claims within the fund, right? And then you are also this is, people who listen to me know I'm a basic man, right? I like, places for
Tacos.
people to live, tacos, places for people to live, farmland, so eating food. And you call this the trifecta, right? This
Right.
is the health. No
Yep.
one is being healthy, going to the doctor, using money to keep yourself alive will never go out of style.
Right.
Just like eating food or living indoors will never go out of style. So I think it's a very reasonable position, right? I don't know if you have, but I've never invested in one of these, newfangled inventions that's going to change the world, and it's just going to blow everything up. I'm just not that smart. I'm not around those circles, and dare I say the venture capitalists that I do know, they'll have 1,000 losses for every win, and might even be a bigger ratio than that. So I like your approach to debt and equity. So when somebody comes to you as an equity investor, right? So they've got a piece of one of your funds, it's in multifamily and it's diversified around. Why would they go to a debt product?
Well, right now we're seeing there's a lot of uncertainty in the market with tariffs, the specter of inflation coming back. Are people worried about there being a recession? What will the new tax package be like if Congress ever gets it put out? And whenever there's uncertainty, there's always sort of a pullback to the sidelines. It's interesting. Everybody says they want to be a contrarian investor and buy during the dips like Warren Buffett, but it's really hard to get anybody to write a check during a time like this. So the logical place then is you put it into something like the medium term fund. It's only tied up for a year. You got liquidity after that. You're making somewhere between 11 and 13%, depending on how much you're paying with us. Well, historically, the S&P does like 10 and a half. So if we can make 11 with us, that's better. And you don't have the uncertainty. It's just a check every quarter without any worry. So I think that's really just investor lack of comfort with the market conditions right now. My expectation is that probably 24 months from now, that we're going to see the sea change where all that money is going to flow out of debt back into equity, chasing returns, but it just hasn't happened yet.
Yeah, if I'm you and I'm running a family of funds, you have to have an equity position, you have to have a debt position, and you're working on both. You're playing both sides depending on the cycle, right? Yep. And I've been preaching, at least to my humble little crew of investors, about private debt for years.
That's amazing.
Now, all my private debt placements are in real estate, securitized by real estate. This is, a very close second, because again, none of what you're investing in here is going to go out of style, is going to become unpopular, is going to close down. Yes, there's nothing foolproof, but I think it's a reasonable position, a reasonable bet.
It's really nice. The technical term for this is it's not correlated really to anything. So if the stock market goes up or down, interest rates go up or down, there's a war in Ukraine or not, who wins in Washington, people get in car accidents no matter what. And doctors are going to help those people get better. And we're going to be there to help them with the financial element of that. And it's nice because I'm so heavily weighted in real estate for my overall portfolio. I like having something that's not tied to rates in real estate.
Yeah, I've been all in on real estate for the last,
As long as I've known you, I think.
Yeah, for at least 20 years, right?
Yeah.
Completely biased towards real estate, and acknowledge my bias. You are absolutely right. Everybody says they want to be contrarians. Everybody says they want to buy when there's blood on the streets. It's just harder to execute that. It's easy from a 10,000 foot view just to say, okay, when I see blood on the streets, I'm charging in. Everybody says that. Very few people actually do it.
It's true. Very, very true.
When you consider your short-term debt offering and your long-term debt offering, obviously there's some risk-adjusted returns there. Tell me a little bit. Let's go back and forth on the risk-adjusted returns between those two debt products.
It's not so much that it's risk adjusted as it is liquidity adjusted.
Okay.
I think about the risk factor across the two of them as being pretty similar. So for the hard money fund, this is being run by a group of ex-commercial bankers who still underwrite in the same really conservative fashion. So you've got some hard money guys. Hard money is like a gigantic, huge thing. So you've got guys that'll do 90% loan to value, and they'll lend to guys that are subpar credit. And then you've got the guys that we work with that they want 35% equity in at least, and they only want to work with credit grade people who've got a decent balance sheet to back it up. So I feel very comfortable that at 65% loan to value, that a lot of things can go wrong and we can still get our money back out of it.
Mm-hmm.
Historically, they've got a failure rate that's pretty typical to anybody else, where they've got to take back some of these things, but they've always had enough equity. They've actually made money on all their foreclosures so far. The frustration with the foreclosures is that you go from a performing asset status to a non. So in the short term, the returns on the fund for a quarter will be lower. And you get this spike when a number of properties sell, and you harvest all the profits on that. So it's not perfectly level, as opposed to the medium term fund. It's just, it's 3% every quarter, 12% for the year. It's just nothing exciting. The less exciting, the better, actually. The challenge with the medium term fund is tied up for a year, and then you need to give a quarter's notice to get liquidity out, versus the short term fund, you don't have all those constraints. So that's really what's driving the difference in the pricing.
Yeah. I like when folks acknowledge, it's not the most popular thing to say, but it is the truth about lending. There is an upside to taking that property back if you've underwritten it appropriately and there's meat on the bone. Now, you don't go in, and this is me speaking as a lender, as somebody who lends private money. You don't go in with the intention of taking that property. It's a pain in the butt. You got to deal with the attorneys. It's no fun for anybody.
It's a disruption to the process nobody wants, and the borrower sure doesn't want the blemish on their credit score and the reputation.
Certainly. Yeah, and what I like about your short-term fund is then in the instance where that does occur, and it does occur, mistakes happen, bad things happen, you get to share on the upside of taking that property over, liquidating it. You're exactly right. It just takes some time. So there's some wiggle and squiggle there, but you do need to acknowledge that is, dare I say, an upside to take that property back, as long as you're not being a predator. And I know you work with integrity, and everybody you work with has integrity. So, and I've struggled with the way of articulating this to folks without sounding mean, right? At the end of the day, if you can't pay your bills and we got to take your property, that's what it is. And then we're going to share that upside with our investors, because they trusted us to manage that investment, and we trusted you to pay the bills. So, it is what it is.
It's just the way the system works. I mean, we're all adults here. If you can't pay the loan back, there's going to be a consequence, or else it'd be a big moral hazard, right?
That's right. That's right. So yeah, we've done that in obviously, residential real estate, but also farmland. And it's, of course, you're picking a fund that underwrites strong. And of course, you're picking a fund that shares in the upside if there's a foreclosure, right? If they have to go take that property.
Well, it's got to be one of two approaches. Either you keep the dividends levelized so that your margins as the sponsor get diluted when you don't have as many performing assets, and then you don't share the upside. That would also be sellable. But their approach, which I think makes more sense, is that we're going to have some volatility. They explain all this up front. It's not like a mystery. And I explain it to all of our LPs, like, it's not going to be exactly 8 every single time. It'll average out to that.
Yeah, I mean, for me as an investor, that's what I want. I want to, ride.
You'll make a little bit more this way,
right? And I'd like to ride the wave with you.
Yep.
And then me as a sponsor, I'd rather do it this way as well, because I want I like the idea of we're all shoulder to shoulder, and we've got our defined roles. When I'm placing a debt deal, my defined role is my team underwrites it. That's our deal, right? The LP's job is just to write a check.
Right.
Right.
We do all the work.
Yeah, that's exactly right.
What
are the risks? What are the risks with the medium term fund? I mean, it's cross collateralized. Is there a lot of attorneys involved that have to go fight for these claims? I mean, there's got to be risk. I'm just not seeing it off the top of my head.
So at the $35,000 level, which is a typical sort of an auto low speed injury, you're going to probably have some neck damage from like a front impact. Those claims don't tend to be very contested. It's just who's at fault is the only question. If you had a basket of $1 million claims, which we don't do that, we want to be at the smaller end. Like if it's $1 million payout, there's going to be a lot more investigation, a lot more paperwork, a lot more everything that goes into that, which is why we don't want to do that part of it. So I think the risk factors on this is that you've got like one genius guy running the fund. So if something ever happened to him, there's a very strong operational group underneath. They'd be able to run the funds that are currently in place. They'd go for their designated horizon. We'd get all of our money back and all the expected returns, but there wouldn't be like an MTI. We're in medium term fund 2 right now. There's not going to be an MTI 3 if something happens to him. That's one. We did look at credit to consumers, not credit to facilities and professionals, and the counterparty would be a large insurance company. That's what we've got. We looked at ones where you could make more just lending to a consumer, but without the collateral, so it's a much higher risk. And our thought on that was that like litigation finance was specifically where we're looking at, where you have someone who's got a really good claim from an injury. They're probably going to get $500,000 to $1 million settlement, but they want money now, so they'd take $200,000 now on some asinine interest rate. There's guys that'll do those loans, and then they'll take the lawsuit as proceeds as collateral against it. We figured that it would only take 4 or 5 guys to be unhappy, even though you disclosed everything up front. Like, I didn't know I was going to pay this many fees, complained to the legislator, and then there'd be law changes. Like, they would just like snuff that out or put a cap on the rates or whatever. We like this a lot better because we're just dealing with counterparties that we like. Not all of the insurance claims are against State Farm and Geico. Some are these fly spec insurance companies. So we expect that some of the fly specs will go out of business and you won't be able to collect. I expect that 2 or 3% of the cases are going to be fraudulent, where you had a neck injury before you got into this accident. We're not going to send you to get more medical work on top of that. Your claim is denied. So that's all just built into it. That's why we're advancing 35% of the value with the expectation that there's going to be some breakage along the way. I think a final risk factor is that you might have like at a state level, because they operate in multiple states. One state might say you can't do this. I can't see any plausible cases to where that could happen, but I've seen a lot of implausible laws that didn't make any sense to me in the past. So I'd hate to always just rule that out. I think those are the risk factors, but I think they're all like things I can live with. If I had 99 things to worry about, this wouldn't make my list.
Right. I mean, there's everything has regulatory risk. I mean, mowing lawns has regulatory risk.
Right.
Okay.
Don't put your hand underneath when the blade's in operation.
Oh, that's right.
Jeez.
I mean, Denver's thinking about making all lawnmowers forcing them to be electric. So there's always regulatory risk in every direction. So you play that game. This stuff intrigues me, right? Who are the ideal LPs for this medium-term fund? I would assume, and tell me if I'm wrong, I'd assume attorneys who know the back end of this stuff, insurance folks, insurance, agency owners, anybody who's been injured and gone through the process of a claim. Anybody who has a little exposure to this, I think, is probably the prior to you, right? Is probably an ideal LP. Who else is an ideal LP for this?
Well, we can only work with accredited investors, but what we've found is that pretty much every accredited investor we've talked to, this has been like pretty easy to explain for them to sort of get their arms wrapped around it. And it's often like the first investment that someone makes with us, and they'll just put in 50 or 100 grand. They'll sit in on it for a year. They'll see that it all works. They get to know us better and like us, and then they start making other investments after that. Our
Yeah.
typical investor, once they've been with us for a couple of years, usually has like 4 or 5 different investments across different funds to even further diversify. But this tends to be the entry one. It's just such a nice one. I think it's for anybody who's got either a desire for current income. So if you're selling a rental property and you're tired of the headache of it, and you're going to have a bunch of proceeds, but you say you're retired, you're relying on the cash flow from that property. This is a very safe way to replace that income. When my wife retired, she's a physician, a year and a half ago, I put a lot of money into this fund. Actually, I'm the biggest investor in it, and I basically replaced her income. And I know every quarter that's coming in, and we didn't adjust our lifestyle at all, which was fantastic. Her pension doesn't kick in for another 4 or 5 years, so this is like a bridge to get through that. That's a common use case. But lots and lots of people from all different reasons who are accredited use it.
It's always worth reminding folks that when your GP is putting their own money right next to yours, that means something. When I'm sent a lot of deals, dozens of deals every week. And one of the first questions is, well, have you done this before? And is your own money in it? Right.
Right.
Those are the two number one and two questions I have. And it's hard to trust a GP when they won't put their own money into it. Either they don't have the money to do it and something's a little fishy there, or they put their money into a better deal and something's fishy there. So, people call me.
And there's the third thing too, and that the problem is, like, if you don't have a lot of capital, you don't have a lot to lose, then your propensity to want to really swing for the fences grows a lot. But all the downside risk is absorbed by the LPs in the deal.
Yep.
What I want is I want a single. I just want to hit singles. I don't want a lot of like home runs, because the risk associated with that is a lot higher. Preservation of principal is our number one priority, and we're going to have a lower return as a result. But if you make 17% a year compounded, if you've got any kind of rational end goal, we'll be able to get you there. It might just take us 2 years longer, but
Yeah.
without the worry along the way.
Yeah, that's completely reasonable. Who is it? Is it Milton Friedman who said something to the effect of the easiest money to spend is somebody else's that you don't know on somebody else you don't know?
Right. What have you really done? Not much.
Right. I also like the quote, don't trust a GP without scars on their face.
Right.
Right.
A lot of truth to that.
Yeah.
I used to
Don't
have a
trust.
full head of hair that wasn't gray.
Right. Yeah. I mean, that's exactly right. I mean, that's kind of a perfect pivot into talking about your team here, because you've got a team who've been in the trenches. I used to be a part of your team.
You were?
Briefly. Yeah. And it was wonderful. Tell me about, the underwriting process, kind of the badasses you have in the world of Ironton Capital.
So there's 3 of us full-time on investment committee, and we're the ones kissing the 1,000 frogs in the swamp, trying to find the one princess out of it. It's just a lot of boiling the ocean. It's not dissimilar to what the investors on this webinar who've got like a 10-unit building, you probably had to go through the exact same process. It doesn't change much. We're just adding a 0 or 2 onto what you're doing all day, every day.
Yeah.
So for most of the value add deals, we're looking at exactly what you'd expect. If the subject property is here, we're going to draw a couple mile radius around it, find the competitors to it, identify which ones have been renovated and are nice, the ones that are not so nice, look at the gradient of how the rents are correlated to the quality of the product, look at the scope of what is going to be done with the renovation, and try to figure out where on this quality continuum are we going to land afterwards. And if they tell us we're going to raise the rents by $350 a month, do we look at the product out there and feel like that's validated, or are they banking on the fact that rents are going to go up 4% per year plus something in a quality gradient, and the combination of the two is going to get us the business case. In the market that we're in right now, I don't want to bank a whole lot on rent increases. I'd rather just assume that we're going to have stability. And if we get in, that's just going to be the icing on the cake. But usually what we'll see with the more established sponsors is that, if they say it's going to be 350, the comps really show it's going to be 425, and we've got a margin for error. That's one thing. Another thing we're really looking for, other than obviously their track record, they've done this a number of times, that are, projects that are very similar to this, is how realistic is the timetable? A challenge that a lot of people don't initially appreciate is that if you're doing a project with like a 2-year horizon, it's got a 20% IRR. If that ends up dragging out for like an extra 6 months, your IRR might go down to something like 16 or 15 and a half. Even if you get the same profit that you expected, just having a short delay on a short burn project really dilutes the returns dramatically. What I like to see is something that's booked on a 5-year schedule, but realistically, we can get through most of the renovation work in 18 to 24 months. We've got about an 18-month cycle of raising the rents and getting one extra bite at it. So now I'm about 3 years into it, and I should be at the NOI that I need, that if it's a friendly selling environment, I can sell that day. Well, if I sell 3 years on what should have been a 5-year project, I'm not going to get a 20. I'm going to get like a 23 or a 24 IRR, whatever the math works out to be. I've got a lot of upside baked into a relatively conservative set of assumptions. And if it turns out that 3 years from now we're in the middle of a recession, or maybe there's something about uncertainty that makes it a very undesirable time to be a seller, I've got 24 months to wait it out and still hit the target case.
Yep.
Those are the kind of things for flexibility that I'm looking for in there. Another thing that you'll often find when you actually get really into the weeds is there enough contingency in this for potential having adjustments to insurance rates? Is there enough contingency that if we open up the walls and we find that there's a problem there we'd anticipate it's going to cost 15% more, can we absorb that without blowing all the economics? It's all this, it's just boring stuff. You just got to
Yep.
grind through all the details and then think through, if this breaks, what am I going to do? If this breaks, what am I going to do? And trying to add it up and say, is it a reasonable number of risks that we could still get a decent return for the LPs? And that's what we're looking for, really. It's there's nothing sexy about it.
There's nothing sexy about it, right? You're in this example, you're betting on the idea that living indoors will remain popular, right?
Yes.
And
Yeah.
then you take the same approach I did when I was syndicating these apartment deals. I would say, hey, a 3-year in and out is a home run. We are targeting 5 years.
Yep.
If we hit 7 years, something's gone wrong, but everybody's still going to make money at 7 years. But
It'll
that would
just
be
be
a
diluted a little bit. And odds
that's
are, like, if we're in a macro environment where selling is undesirable, it's not going to be just for us. It's going to be for absolutely everybody. And that set of unpleasant market conditions are probably also going to weigh down on the S&P 500 and the bond market. So at the end of the day, like, what's my job? I've got to outperform the S&P because you're tying up the money for 5 years. You don't have liquidity. So if the stock market does poorly because the macro environment's terrible, and we don't do quite as well as we hoped because the macro environment's terrible, I could probably still keep the same spread. I've delivered what I had to the LPs, and things have worked out.
Yeah. Well, that's what this show's all about. I mean, this show's called Capital Stewardship. You are a steward of not only your capital, but your investors' capital. And then what we've done is we've also, another thing that I find fascinating about you, I'm going to make a big pivot here, but I also consider capital as human capital, right?
Mhm.
Energetic capital. So you've made a lot of people wealthy through
Yeah.
your capital. Yeah, I mean, you've helped a lot of people become millionaire real estate investors. I'm one of them. So yes, you're being a good steward of capital when you're looking at these deals, diversifying the risk, articulating it well, and you're still managing these people that are singing in the chorus of your choir here,
Yep.
right? I'm really interested in learning more about how you're managing them, specifically the let's call it the top tier guys and gals who are helping you vet these deals, and then the tier below them who are helping articulate these deals to the investors. So, investment committee and let's say IR.
Yep.
Let's talk about how you're managing them.
So for the investment committee, it's myself and then Brent Geyer, who had been a realtor with me for about 15 years. The fun thing about Brent is that he was a CPA when he first got started, and then he worked at a corporate level with Lennar, the big home builder, acquiring land. What was really way to really get to know Brent well was back in about 2008. So for those of you who are not familiar with the Denver market, we went into the great financial crisis first and we came out of it first. So by 2008, it was like a complete free fall. And by the first quarter of 2009, you couldn't prove that we had hit bottom, but it had all the indication, like if we were at bottom, this is what it would feel like. And I went to Brent and I said, the overall average price in Denver's gone down by 25%, but it varies greatly by neighborhood. If you look at a high quality neighborhood where there's affluent people with large down payments or they're all cash, the prices haven't really gone down at all. If you look at what was all first time buyers buying with 0% down, some of those neighborhoods have gone down by 65 or 70%. It's unbelievable the carnage that took place. So there were condos selling for $20, $40, $50,000 that the value of the water tap in the land would be worth that. And you're basically getting the entire building for free. I said, what I want to do is I want to look at the 40 most affordable condo complexes, get all the HOA documents, underwrite the financial stability of the HOAs, identify the top quartile. And those are the ones I want to buy as many units as I possibly can, whether we're at the bottom or not. And he and I did that analysis and we figured it out. I bought about 140. I think he bought 25 or 30, and we sold hundreds to our clients. I have one particularly great memory of, we bought an 8-pack of 4 1-bedrooms, 4 2-bedrooms, and I think I paid $320 for the entire package. And those were all worth like 150, 200,000 within 8 years. So he helped me do that, and he's basically just applying the same discipline now. He's more of a new development guy, so for our new development projects, he's really good at ripping things apart and like saying, well, here's a problem with this land with access. Like, I would have never thought of that, only because he's done it so many times.
Yeah.
And then Richard Landry came to us from Goldman Sachs as an analyst, and then he was the chief investment officer for a pretty large family office, a multi-billion, and also worked, I think, as a chief financial officer at a large multifamily private equity fund before coming to us. So he's just been doing this nonstop for well over a decade. So he's the real quantitative, deep modeling guy. I'm good at spreadsheets, but Richard's like a whole nother level of being able to get into stuff. So collectively across the three of us, we all have different blind spots and we see different things, and it's across the three. It's really fantastic.
Yeah,
and
Brent was a KPMG guy as well, right?
I think it was KPMG. Yeah, I was at Deloitte. I was on the consulting side. He was on the accounting side. But yeah, absolutely.
What's the saying? You never get sued for using KPMG.
That's right. Don't get fired for buying IBM, and you can go with a big brand name like that.
That's right. And then what about the next tier, your IR team?
Yeah, so investor relations is led by Nick Elder. He does a fantastic job with that. And then we've got 3 other gentlemen underneath him that are just working the phones all day and then doing follow-up calls to people. I actually, just before this, I recorded the final Fund 10 investment lineup explaining all that. So the guys will watch that on Monday. They'll drop a lid of questions. We'll do a lot of Q&A and role playing, and then they'll be getting peppered with a bazillion questions, and they'll be well equipped to answer them.
Yep. When did Ironton get founded?
3 years ago, next month. This is month 36.
Congratulations.
Yeah.
You've shot up like a rocket ship.
Yeah, 90 million from friends and family, if you can believe that. It's unbelievable.
Well, that's just a testament to the network you've built over the last 2-3 decades in real estate, being a steward of capital, not only financial capital, but debt, equity, human capital.
Right.
I mean, you still have, you're the founder of your castle. You still have maybe a little piece of that. It doesn't really matter, but you still office there, right?
I do.
Yeah.
I probably spend about 5 hours a week on just helping to run your castle with the leadership team, and I still coordinate the real estate trends, and I still bring on special topics that I think will be interesting to the agents, where I think maybe I could have something to help out. So I wrote a book 2 years ago on how to succeed in a down market when the market really made that shift when rates spiked, and then I wrote a book that we released this spring on how realtors can succeed with artificial intelligence. So I still do some things like that, which is really, really fun.
Yeah, I love it. I get those emails, and I'm on your email list, and you're always pumping, 800,000 people with good content for real estate. So anybody who's listening that wants to stay in touch, you got to get on Lon's email list. Highly recommend.
Delighted to do it.
Yeah. What's the future hold for Ironton? I mean, I can guess, but what's your direction? What's your vision? Give me a year, 3 years, 5 years down the road.
Well, I think in addition to the reaching out to people who already know us, like us, and trust us, we're getting a little bit more effective. I wrote a book on passive real estate investing, and we're using that as a magnet to attract people who don't know us, and it's a way to
Mhm.
educate them. But I think there's a large opportunity for funds on the equity side in real estate to partner with us because they've got a large base of investors who know, like, and trust them. But those investors are probably seeking something like the medium term income fund. So we can white label, like when you used to go to Sears to buy a Whirlpool appliance, they would call it whatever the Sears brand name was. It's white labeled, but it was really made by a really great manufacturer, Whirlpool. Kenmore, I think is what
Mhm.
they called it. We're in the final stages of wrapping that up actually with the one boutique capital fund and one very large institutional fund, where we'll be offering our medium term income fund to their limited partners under their brand name. And it's a great opportunity for them because they're used to being on an economic model where they get some small percentage fees each year to keep the lights on. But since we haven't had a lot of liquidity events, there's no easy way to get that money out. So they're probably financing their operations out of their own pocket, which is kind of stressful. The idea of having a debt fund, which is very much in demand right now, that pays a quarterly dividend to your LPs, and then you get your cut of it every quarter just to cover your overheads, is immensely attractive to people who are fund managers on the equity side. So I think that's going to be our main focus, is getting to know a lot of them, explaining to them, and partnering with them, and that'll really supercharge growth.
Yeah, I like that. I like partnering with smart, trusted people where you don't have to do all the lifting. I mean, listen, you're a sharp guy, but you have two other sharp guys that you all have your blind spots, but you all cover each other's blind spots. Well, the same thing here. If you're let's say you're a micro cap private equity fund, you've just been doing, multifamily real estate or ag or whatever, and maybe you've dabbled in, maybe you've even dabbled in hard money lending. Well, this medium term fund is something that you probably haven't thought of. If you're going to start it from scratch, it'd be a pretty heavy lift,
Yeah.
and shoulder to shoulder with you would be a good thing.
Yeah, well, the nice thing is we've already thought through it. We figured out how to explain it. We just make the whole thing turnkey, and we can come up with some economics that are really a win-win for both parties. And most importantly, it's a huge win for the limited partners who are involved.
Right. I mean, at the end of the day, if you make people with piles of money grow their piles of money, they will remember you.
Oh,
And if you
absolutely.
do it in an easy, efficient, highly communicative manner, they will remember you.
Yep.
If you don't communicate well, if you don't make them more money, they'll never use you again. It's this private equity stuff is simpler than folks make of it. You
It
know,
is. It's just doing the work, showing up, and just trying to boil it down to the essentials to make it not complicated.
right. You said something a little earlier about, boiling the ocean to see what you can get out of it. How many deals do you look at per deals you move on? Back when the market was booming and it was pretty darn easy to make money in real estate, I was still looking at 100 deals for every one I would close. Now it's different, right? And not just real estate, but now when you open up the private equity world, there's just a lot more opportunities. How many deals are you saying no to per deals you say yes to?
It's probably not as high as 100 because I think we've got some initial screens that filter out a lot of the things that
Right.
just don't make sense. So it's certainly multiple dozens. And then we try to say no quickly to people just because they're usually on a schedule and they don't want us to drag things out. So, for the ones that we actually underwrite in detail, it probably gets down to like 10 to 15 for one
Okay.
that we actually end up taking. So you don't want to put all that effort into something unless you think that you've got a relatively good chance. The challenges you get in there, though, is when you really get into their detailed Excel sheets, like they've got like a whisper thin, contingency line item, or you fly out there to go see the property and like, this is a friggin' disaster. This is not nearly as good as you represented it to be. A lot of the field trips are where a lot of stuff breaks down, because we try to go see everything in person at least once. Some of the crap that people have tried to get us to invest in, I'm just, why did you pick this project? There's so many better ones out there.
Well, yeah, it's funny. Everybody looks pretty behind a screen and behind a spreadsheet, right?
Right, right,
Spreadsheets are the best liars known to investors ever.
right.
Um, yeah, I mean, I'm with you. I like to get boots on the ground. As I get older, as I get wiser, I've been getting, and I'm still working on this. I mean, I was writing about this in my journal this morning about working on my velocity of no. right?
Yeah.
How fast can I say no? I'm far faster than I was 10 years ago, 5 years ago, 3 years ago. But analyzing my blind spots, I'm still not as fast as I'd like to be to say no. This is some Chris Lawhead counseling time now, Lon. How do I get faster at saying no? Like what, let's just start with that big ass general question.
Well, I don't think this is going to apply to you, but it might apply to some of the listeners. I think, you can't get what you want unless you know what you want. And that sounds very simplistic, but it's amazing how often I'll meet with someone and they don't have a really crystallized idea of where they're trying to get to and like the 15 steps it's going to take to get there. And then what are the gating criteria on each of those steps to know, am I ready to take this step or not? Is this the right thing to go through the next step of the process? So I think just understanding what rate of return thresholds you've got to be at, what key assumptions are probably going to drive success or failure in achieving that goal. How rapidly can you get your arms around? Is it realistic with the set of assumptions they've got on here? I think that's a lot of it. And some of it's just, it's just a gut feel. Do you trust this person? They've got a track record. You validate that it's there, but you've got to really believe that they're going to try to do the right thing. And if they get in trouble, like if things go well, everybody does the right thing. Like it would be suicidal not to. If things don't go well, that's what I'm worried about, right? Are you still going to try to hold up to all your commitments on your side? So I think just getting really, really clear about what you want, and not being embarrassed about saying, this one doesn't match for us. Here's the 3 things that we looked for that didn't work out. Um, Generally speaking, I like your strategy a lot. I'd love to look at future things that you've got coming down the pipeline. Please keep us in mind. And we're all adults here. Like this, just a business decision.
Right. I do really like, because people have done this for me, to me, and not for me. I like to articulate when I say no, why. And I like to
Yes.
do this as fast as possible. I don't ghost them. I don't give them vague. I say, hey, this return isn't within my parameters, or this asset class is not leveraged, or is too leveraged, or whatever it is. I want to give them solid reasons why I'm saying no. And what that does then is they'll come back when they have something that you might say
Does
yes to.
line up into the box that you need it to be. Yeah, when I get an Excel or an OM, I'll try to get a response back within 4 business hours of, at a high level, I don't think this is going to work, and here's why. Or I'll tell them at first blush, I think this actually could work for us. So, you're probably in your final 10 as opposed to the 90. I'm going to need a couple days to get further into it. Will that work with your timeline? I'll always ask them, like, how much time do you need to hear back from me? And usually they're pretty clear about that, because usually they've got some pressure time-wise.
Right. I call it the napkin test. Can
Yeah.
I take I have single sheets of paper all around. And if I'm on the phone, whatever I'm doing, can I napkin test it in 5-10 minutes? Right.
If it's one that's for us, it'll usually be that easy. If it's not, then it's probably not the right transaction for us. Because if it's tight, you're relying on a lot of stuff to go right, and stuff doesn't go right that often.
Right. Welcome to Earth. Right. Yeah. That is, the story of everybody's life. All right. Now we've talked about how to make money, right? Let's talk a little about how to keep money, right? With our tax efficiency angles. You've got a few of them. I mean, obviously, most of the people who listen to me are real estate people, right? They invest in real estate, they invest in loans. There's obviously tax efficiencies there. When they make that step up, they're credit investors, and they make that step up into these private equity funds. Where are the tax efficiencies, right? Can they expect the same ones they got when they were buying their own 8plexes in 16 units? Tell me more about tax advantages and disadvantages about coming in as an LP on private equity deals.
Yeah, so for our long-term fund, we have 2 share classes. So there's an A class that gets a slightly higher pref, but it gets none of the depreciation allocation or losses. And there's a B class that gets a slightly lower pref, and it takes all of the depreciation and losses. Traditionally, what we find is about 80% of our shareholders are in the A class, and it's a very small number that want the depreciation. So you'll want to talk to your tax professional, but as a quick litmus test, like if you're a W-2 employee and you don't have like a lot of losses from maybe trading your stock portfolio, tax losses from us are probably not likely to benefit you in a meaningful way. So you probably want the higher preferred return in the A class. That's our typical use case for that. Also, if you're using a self-directed IRA or a self-directed 401k, you're not going to be able to deploy those tax losses for anything. So take the higher pref. The people who most typically will benefit from the write-offs are the people who own like the 8 unit that you described. They're tired of being a landlord, fighting with the tenants. They're going to sell the property off, and they're going to recognize a pretty healthy capital gain and depreciation recapture. So again, your tax professional will help you fine tune and calibrate this, but the depreciation losses that we can get to you should dollar for dollar offset your capital gains. So it's like a synthetic 1031 exchange, but you're getting yourself off of the active management treadmill. Now, what's exciting right now is that if you put like 100,000 into NDF 10, we might be able to give you $35,000 of write-off in year one. If you remember back to Trump's first term, he did a tax reform package that greatly accelerated the recognition of depreciation, particularly for real estate assets. It looks like the current legislation that's getting close, supposedly, to passing, is going to have almost the exact same language in it once again. So I wouldn't want anybody to invest expecting Washington does anything, because who knows what they'll do.
Right.
But there's a decent case that we could deliver a lot more than 30% write-off in your first year, and then really knock out all of your capital gain and maybe, take care of all of it for you. So for most people, what this does then is effectively kicks the can down the road for another 5 years. Doesn't make the problem go away. You're just delaying it. So then what'll happen is Fund 10 will mature. You'll be rolling the funds into Fund 19, buying the B share class again and kicking the can down the road for another. So eventually what'll happen is your kids will inherit it, and it'll be the same step up in basis as you'd have if you owned a rental property. Your kids would inherit it, not at the 100,000 you paid for it, but the $500,000 market value at the time of your passing, and then they sell it the next day for 500, and there's no tax liability. Check with your financial team, but you should have the same sort of tax benefit with us.
Right. Yeah. I mean, I'm one of those guys who likes the B shares because I'm always buying real estate, exiting deals, getting in deals. And like you said, I'm not a tax advisor, talk to your professionals, but I've essentially created what I call an LP ladder, similar to a bond ladder. So a bond ladder, you buy a 3-year bond year 1, 3-year bond year 2, 3-year bond year 3, and next year, and then they start maturing and on you go. Well, consider an LP ladder, right? And let's just say it's a 5-year. So you get in on a deal, year 1, year 2, year 3, year 4, year 5, and then that first one matures. You're in those, the B class shares where you get that depreciation, which is, I go hunting for it. Right. I'm one of those guys on your short list that you call when you've got some depreciation to offer.
Right.
And it can work really well with those ladders. Of course, there's regulatory risk because you don't know what Congress or anybody's going to do ever. There is I think it's reasonable that they don't shoot themselves in the foot. So if congressmen and women invest in real estate, they invest in private equity, they might vote for things that are beneficial to them. Again, who knows? But I think that's a reasonable approach. But yeah, I go hunting for that depreciation, every year.
Absolutely.
Right?
Absolutely.
Well, I tell you, a lot of this I've learned by talking to you and some others like you. So I'm super grateful that I get to talk with you, even sometimes once a month at tacos. Exactly. And now on the show. It's always great to talk to you. Lon, we close this show out always with, what are you grateful for? So I'll start, man. I'm grateful to know you. I'm grateful that I got plugged into the Your Castle, family many, many years ago. I think the first exposure I had is I took how to rent a property, how to buy a rental property. And I was in the back of the room going, I can't do this with one. I got to do this with 8. So my first rental was an 8 unit. So I'm grateful I got plugged into kind of your ecosystem. What are you grateful for, man?
I think good health, it's something that's so easy to take for granted. And then we had one of our realtors who's, just a middle-aged woman in good health who died in her bed a couple of days ago out of nowhere. And it's just jarring. So don't take good health for granted. And if you've got a chance to go do something with your family outside, go do it.
I love it. The saying, a healthy man has 1,000 desires and an unhealthy man has one. Yeah, that's
right.
I'm with you on that. Well, thanks, Lon. Let's do this again. I'll see you next time at the Taco Shack, and hopefully you'll come on the show again.
I would love to do that. Thank you so much for the time today. I really appreciate it.
Absolutely. We'll talk to you soon.
All right. Thanks a bunch.
Bye-bye.